Hello to all my dear students. Today we are going to start with partnership fundamentals. Now in class 11 we have already studied the final accounts of sole proprietorship. Now we know that what do you mean by sole proprietorship? A business which is being run by an individual. So in this chapter we have learned in class 11 that how to calculate the gross profit, the net profit, and the net profit is being transferred into the capital accounts of the sole proprietorship. Now we have reached in class 12. We are going to study the further up, that is the partnership. In partnership, now the business has been growth or more, so we require more than one person. So when, for example, we have taken two or more than 2 persons are being joined together to start up an own business. When they are joining together, they are known as being a partner, and these partners are going to open up a firm, which is known as partnership firm. So what is partnership firm? Partnership firm is a relation. What it is? It is a relation between two or more than 2 persons, between 2 and more than 2 persons who agreed to share profit, of a business, or we can say a firm, carried on by all or any one of them acting for all. Now this part we have already learned in class 11, that is in business studies, that what is partnership. So we all know that this partnership is a relation between 2 or more than 2 persons who have agreed to share the profit. We know that whenever the partnership is being done, it is being done only to share the profits of a business, which is carried by any one of them. Now when any one of them is acting for all, then it is known as mutual agreement. We are going to learn in the future, that is when the business is being carried on by all or any one of them acting for all, that is known as mutual agreement, which we have already learned in class 11. So that whatever the theoretical part is there in this partnership, we have already done in class 11. We are just revising those particular topic, that partnership is a relation between 2 or more than 2 persons who agreed to share the profit of a business carried on by all or any one of them acting for all. Now coming to the next part, that is features of partnership. Features of partnership. Now we already know that it is a relation between 2 or more than 2 persons. So the first feature is that we require 2 or more than 2 persons. But do we know that how many persons are being required? Maximum number of people. Minimum is being 2 and maximum is being 50 according to the Companies Act 2014. That Companies Act says that we can have minimum 2 persons and maximum 50 persons as per Companies Act 2014. So the first feature is that a partnership can have 2 or more than 2 persons. The second feature, that is the agreement. Now this is the most important part of this particular chapter, that is the agreement. Now the agreement is generally being oral or written. We know that in this partnership the agreement is not compulsory, but if it is being done, then it is being the best part of it, because the partnership should be done in the written form, but the partnership can be done in the oral form or the written form. So the agreement is being known as, when it is being done in the written form, it is known as partnership deed. So the agreement is being done either in the form of oral or in the form of written. Now whatever the business is being run by the partners, it should be a lawful in the eyes of the government. It should not be that we start doing the smuggling business between the 2 or more than 2 partners. that two partners are being joined together and they start doing the smuggling, then it never be done as a lawful business. So what do you mean by lawful business? That in the eyes of the government, whatever the business which we are running should be lawful. Lawful, that it should come under the government's rules and regulation. Then the next feature is the profit sharing ratio. Now if it has been the profit sharing ratio, now if the partnership is being a written agreement, then the two or more than two partners will decide at which ratio the profit will be distributed. Because at the end of the day, whenever we are carrying the business being run only for the profit. It is not being done for the non-profitable organization, which we have learned in the previous chapter. It is being just run for the profit organization, and when it is a profit organization, the profit is to be distributed among all the partners. So it is decided by the partners at which ratio the profit will be distributed. If it is not decided, the profit will be distributed in the equal ratio as it has been said in the Indian Partnership Act, that the profit should be distributed in the equal ratio. So the next feature is the profit sharing ratio. Then the last feature, that is we have already discussed in the definition, that is mutual agreement. Now what do you understand by mutual agreement? Now for example, there are two partners A and B. Now A said that I'll be the partner of the business, but the business will be run by B only. So the B and A has decided that the business will be run by the B, but the profit will be distributed in the ratio of 1:1. So the B is taking care of all the business activities, but the profit will be distributed among A and B in the both. So it is said in the definition that it is a relation between two or more than two persons who agreed to share the profit of business carried on by all. That is, it is being carried on by all. That is, B is carrying the business. A and B together are working, or any one of them. Or I have told you that B is going to work, and the profit will be distributed among A and B in an equal form. So either A and B will together be working together for the business to earn the profit, or only B is going to perform the activity, and the profit will be distributed by A and B both. So it is a relation. So we can say that business can be carried by any one of them or by both of them, so that for earning the profit. So this is the meaning of mutual agreement. The next topic we are going to talk about, that is right of partners. The right of partners says the first right is being said, that is to share the profit in agreed ratio. Whatever the profit is being earned by the partners, it should be shared in the agreed ratio. If there is no agreement between the two partners or more than two partners, then the ratio will be shared in an equal ratio as per Indian Partnership Act. So this is the right of a partner. The second right is that if he feels that the business is not being run by me or by the other partners in a proper way, then he can take part in the conduct of business. So the second right is to take part in the conduct of business. The second right is to take part in the conduct of business. The third right, if he feels that whatever the accounts which are being made by the partner A or B, or whatever the partner is not being done in the proper way, then he has a right to show those accounts or show the information to the other person, so that he can get the consultation whether the things are being done in the proper way. So the right of partners, that is right to be consulted, that every partner has a right to be consulted whether the things should be done in a proper way or not, or we have to take the decision from all the partners that the things should be done or should be move further out or not. And the fourth right of a partner is the right to inspect. If the partners feel that the books are not being managed in a proper way, or there's some misinterpretation is being done in the books of the accounts, then the partner has a right to inspect. The partner has a right to inspect the books of the accounts, so that he can find out whether the things inside the business are being running in the proper way or not. Then a partner has a right to retire whenever he feels. So the partner has a right to retire from the firm whenever he wants. Whenever a partner feels that he wants to leave the business, he wants to retire from the business, he has a right that he can retire the business from the business whenever he feels. And the last, the most important right of a partner, that is to disallow admission of a new partner. Now, why I said it is important part of the right of a partner. For example, this is a firm, and in a firm there are 40 partners. Now one person wants to be the part of the firm, for which 39 partners are ready, but one partner disagree that that particular person cannot be the partner of this firm. Then when one person disagrees, then this partner cannot be the partner of a firm. That is the right of a partner, that he can disallow anyone to be the part of a partnership firm. So this is one of the rights to disallow the admission of a new partner. So we just revise it up. The first right is to share the profits in agreed ratio. If the ratio has been decided, then it has been done in that particular ratio. Otherwise, according to Indian Partnership Act, the ratio will be distributed in equal ratio. Then every partner has a right to take part in the conduct of the business. Then every partner has the right to be consulted whether the steps should be taken in the prospective ways for the business or not. Every partner has a right to inspect the books of the accounts. Every partner has a right to retire from the firm whenever he is needed, and every partner has a right to disallow the admission of a new partner. So these are the rights of a partners. Now coming to the next topic, that is partnership deed. Now this is the most important topic because this only creates the framework of how the profit should be distributed between the partners. Now partnership deed, we have already talked about it, that it is a written agreement which is being done among the partners. Now, if the partnership deed is present, then what are things are being seen can be given to the partners, and if it is not present, then we follow Indian Partnership Act. Now in this part we are going to talk about if the partnership deed is present, then what are the things are being given to the partners according to the agreement, and if it is not present, then what we follow, then we used to follow the Indian Partnership Act, and according to Indian Partnership Act, what are the things which are being required to be seen. So the first thing, that is interest on capital. Now what is interest on capital? For example, this is a firm. Now what does the partner used to give to the firm? For example, this is A and B. Now what does the partner used to give the firm? The partner used to give the capital. Now when A used to give the capital to the firm, then he will be needing something. So the firm will give interest on the capital which is being given by the partner. So if the partnership deed is there, so if the partners agree that they are ready to distribute the interest on capital, then it will be distributed. If it is mentioned, then it will be given, it will be distributed. But in the partnership deed, if the partnership deed is not there, then according to Indian Partnership Act, it will not be paid. If it is mentioned in the partnership deed, then it will be distributed in the prescribed ratio, prescribed percentage. And if it is not present in the partnership deed, or partnership deed is not present, then we follow the Indian Partnership Act, and the Indian Partnership Acts that interest on capital will not be paid. In the similar way, interest on drawings. Now, interest on drawing. Now, what is interest on drawing? Now, A has withdrawn money from his capital, that is temporary in nature. Drawing is generally being temporary in nature. So he has withdrawn a drawing. So it's a loss or an expense for a firm. So when it is an expense for a firm, then the firm will also wanting something. Then they will ask from the partners that they have to pay the interest on the drawings which is being done by the partners. So that is known as interest on drawing. So interest on drawing is being paid by the partners to the firm. So for the partners it is an expense, and for the firm it is an income. So interest on drawing, if it is mentioned, then it will be distributed. It will be given by the partners to the firm. If it is mentioned in the partnership deed, then it will be distributed by the partners in the agreed ratio, in the agreed percentage, and if it is not being written in the partnership deed, or if no partnership deed is being there, then according to Indian Partnership Act, it is not allowed. Now, some of the partners decide that when they are working in a firm, they want that whatever they are working, they should be getting the salary. Or if they are doing any part of the activities in the firm, they should be getting the commission. So next is salary or commission. Now, salary and commission. Salary, if it is mentioned in the partnership deed, then or commission, if it is mentioned in the partnership deed, it will be given. But if it is not being mentioned in the partnership deed, or if there is no partnership deed, then according to Indian Partnership Act, it will not be paid to the partners. Then the next one is interest on loan. Now, what do you mean interest on loan? If a partner has given the loan to the firm, then the partners decide at which rate the interest to be given by the firm to the partners. If it is mentioned in the partnership deed, at that prescribed percentage that is mentioned in the partnership deed, that rate of interest will be given in the form of loan to the partners. And if there is no partnership deed, then according to the Indian Partnership Act, it will be given at 6% rate of 6% per annum rate of interest. So the interest and loan will be given to the partners if it is mentioned in the partnership at that percentage, or if it is not mentioned, then it will be given at 6% rate of interest. And last, that is the profit sharing ratio. The profit sharing ratio, if it is mentioned in the partnership deed, then at that prescribed ratio, and if it is not being, no partnership deed is there, then according to Indian Partnership Act, the ratio will be distributed, the profit will be distributed equally. So this is the difference between the partnership deed when the partnership deed is present and when the partnership deed is not being present. Now the next topic that we are going to talk about, that is very new to you, which you have not learned till now, that is profit and loss, how to create a profit and loss appropriation account. Now before we start, we talk about we'll go a little bit back, that how to create a profit and loss account, and from there we'll start that why we used to create profit and loss appropriation account. In the class 11 we have learned how to create profit and loss account. Now everyone knows how to create a profit and loss account. It might be learned by heart by most of you, because the question used, everyone was thinking about that the question will come of 10 marks, and you have learned by heart how to create it, and 100 times you might have done it in the last year. So everyone knows how to create it in profit and loss account, where we used to calculate the net profit. And how we used to calculate, that is, on the left hand side, on the credit side, we used to write down the buy gross profit that has been transferred from trading account. Then on the debit side we used to write down all the indirect expenses, and then we used to balance it out. When the credit side is more than the debit side, then we used to balance it out. That balance figure is generally being known as to net profit, and this net profit we generally used to add, because we were learning the sole proprietorship, we used to add this net profit in the capital of the sole proprietor's capital in the balance sheet. But when we are learning the profit and loss appropriation, when we are learning the partnership, then this net profit will be transferred to the profit and loss appropriation. Now profit and loss appropriation account is generally generally shows the distribution of the profit among the partners. So this net profit will be transferred to profit and loss appropriation. This is a new topic which we are going to learn. Today I am going to tell you how to create this profit and loss appropriation account, and in the next video we will start doing the questions. So profit and loss appropriation account for the year ended, whatever the date will be given. Now this profit and loss appropriation account is generally known as nominal account. Which type of account it is? A nominal account. Now what does the nominal account says? That whatever the expenses are being there, it will be written, expenses and losses will be written on the debit side, and whatever the income will be written on the credit side. Now when we are creating the profit and loss appropriation account, we are creating on the basis of the partnership firm. Whatever the accounts we are going to create in this partnership, we are going to create on the basis of the partnership firm, not on the basis of the partners. So profit and loss appropriation account shows the distribution of profits among the partners. Now let us imagine there are two partners, A and B. So in the profit and loss account, whatever the profit has been earned, that is in the form of net profit, that net profit will be transferred to the profit and loss account, and we'll write down as by profit and loss account. That is the net profit which will be transferred on the credit side of the profit and loss account. Now if the partnership deed is present and it says that interest on capital is to be paid, so that interest on capital is an expense for a firm, so it will be written on the debit side, that is to interest on capital, which is being calculated on the prescribed percentage and be distributed. We have already imagined we have two partners, A and B, and it will distribute it among the partners A and B in their prescribed percentage, in their prescribed, which is being calculated on the basis of capital, which we are going to discuss in the next video. Then If the salary is being mentioned, then the salary will be paid to the partners, to partners salary. This is also an expense for a firm, so it will be written to partner salary account, which will be given to the partner. If the partner is doing some taking out some projects for which he will be charging a commission, that commission will be given to that particular partner and will be written on the debit side. That will be says at two partners commission account. Then every firm keep some reserve for the future expenses, so they will the firm will transfer a certain amount of will create a certain amount of reserve for their future expenses, so it will be an expense, so it will be shown as to transfer to reserve account. Then if the partners have withdrawn or taken out drawings, they will are going to pay the interest on those particular drawings, and those particular interest on drawings will be an income for the firm that will be shown on the credit side, that is by interest on drawing, which I have already explained you what is interest on drawings. That is the interest which is being paid by the partners to the firm on the drawings which is being done by the partners. So if the partner has done a drawing, that interest on drawing will be paid by the partners to the firm. That's why it is an income for the firm. And then after calculating, after writing down all the things, when the credit side is more than the debit side, then it will be a profit. And how it is written? That is written as to profit transferred to, now, is capital or current. Now this part, capital, or why I am writing capital and current, I'll explain you in the next video or in the next video, that what do you mean by when we are going to use to write down capital and when we use to write down the current. A is capital or current account, or B is capital or current account. We add up whatever the balance will be at, and that will be distributed. This particular profit is distributed in the ratio of that, in the agreed ratio. If it is not mentioned, then it will be distributed in equal ratio. So the profit which we have transferred, which is the balancing figure, is being distributed among the partners either in the agreed ratio or in the ratio which is being given by the partners in the partnership agreement, that is the agreed ratio, or if it has not been agreed, then it will distribute equally among the partners. So why we have written capital and current will be discussed in the next video. Now before I close up this particular video, I just want to talk about those two important points, that is drawing and withdrawal of capital. Now you should remember these two things which are very important. Now drawing, that is always being temporary in nature. Why it is being temporary in nature? Whenever we are drawing the drawings, it can be taken out at any moment of time, and when we have the money, we used to deposit that particular, or we used to bring that particular money back into the business. But withdrawal of capital means we are taking out the money permanently. We are not going to add up that money again. So that's why withdrawal of capital is generally being permanent in nature, and drawings is always being temporary in nature. When we are doing the drawings, we used to calculate interest on drawing. And when we are doing the withdrawal of capital, we used to calculate interest on capital. So in this video, we have talked about what do you mean by partnership, what are the features of the partners, what are the rights of the partners, when the partnership deed is present, what are the things to be given, and when it is not being present, when the partnership deed is not being present, then we used to follow the Indian Partnership Act. How to create a profit and loss appropriation account, what are the things which are being mentioned in the profit and loss account, and what do you mean by drawings, and what do you mean by withdrawal of capital. In the next class, we'll start doing the questions based on profit and loss appropriation account.